Sykes. I'm a shareholder with the accounting and advisory firm for pharmacy Sykes Company, PA. With me today is Scott Sykes, a shareholder, a CFP, and a CPA with our firm Sykes Company, PA. And today we also have with us Liz Delude, who's a chartered financial analyst at Palladium Registered Advisors, and Walker Phillips, who I believe is a CFP, if I'm correct on that, Walker.
Yes, sir.
Palladium is a firm that our firm Sykes Company has had mutual clients for some 40 years. In fact, it probably goes back even longer than that. And we're very proud to have them on the Master the Margin program today. And with that said, Scotty, I'll pass it off to you.
All right. Yep. Welcome, Palladium. Glad to have you on. Appreciate you doing this. Kind of switching gears a little bit with our Master the Margin series by going into more of on the investment side and estate side, those kinds of things. So we're glad to have Walker and Elizabeth or Liz here. And Walker, I'll just pass it over to you guys.
Yes, sir. Thank you, Scotty. Thank you, Alan. It's a pleasure to spend the hour with you today. Again, as Alan was kind to say, I'm Walker Phillips, here with my colleague, Liz Delude. Our firm, Palladium, is an independent fee-only registered investment advisor based in Virginia. And as Alan said, our team is fortunate to have worked closely with Sykes & Company for decades. And time is important in our work. And it's over decades that we've seen Alan and Scotty and their team help pharmacy owners build significant nest eggs and really improve the quality of life for their families and the families of their employees. They are truly experts in the pharmacy business, and we are honored to be part of this discussion today. So there are many components to a solid retirement plan. As investment advisors, when we meet a new pharmacy owner client, they expect us to ask questions about investments, and we do. But many times these questions come later, once we've had a chance to understand exactly what you need to accomplish. We want to make sure that you're not subjecting yourself to a more significant risk that could cost you or your loved ones hassle and expense. Always shocks me to hear of famous people dying without a will. When Sonny Bono died in 1998 without a will, both his widow and his ex-wife Cher and a love child showed up as claimants of his estate. Does that sound like a good plan? No. Michael Jackson's estate generated $242 million in the first year following his death. So you can imagine the stress his family felt when they couldn't find his will. Fortunately, his will was found and the state was not forced to divvy up his assets. But there are still disputes amongst family members about how the estate was divided. It just opened everything up to question. So the point being, even if you're not the king of pop, a will protects the people that you care about, and it saves them time and money. Likewise,
Walker, I hear Prince also didn't have a will.
Prince
and
died.
He's had 100 people going after that estate.
It's the same thing.
Yep.
How would people know what your wishes are unless you find a way to record them? And that's also true while you're alive. Power of attorney, advanced medical directive, it speaks for you, and it speaks about how you want to handle your affairs, how you want to be treated in the event that you can't speak for yourself. So, the will, power of attorney, advanced medical directive are priceless. You know, if the assets that you save don't go to the people that you intend, the rate of return seems much less important. Next slide, please, Scott.
And that advanced medical directive, you know, has gotten a lot of attention lately with the COVID and everybody, you know, being hospitalized and not being able to speak for themselves. So that's definitely gotten some traction here with this pandemic.
Yes, just a means of recording your wishes in case you can't speak.
Yep.
Very important. And to that end, step one for us in any kind of financial review is to make sure beneficiaries are current. And you may have heard stories of people naming a spouse as beneficiary of a retirement account at the start of their career, later getting divorced, remarrying, starting a family, etc. Imagine the shock of that family to learn that the ex-spouse from decades ago is legally entitled to their nest egg. And important to know as well, beneficiaries aren't just for retirement accounts. There are ways to title after tax or brokerage savings, even real estate, in a way that avoids probate. And even if you have a will, court goes through a process of distributing your estate that can be time consuming and hassle to your heirs. And when you name beneficiaries on a retirement account, these assets get to skip the probate process. They go straight to the beneficiaries that you've named. And this can also be done with non-retirement assets by placing a transfer on death or TOD beneficiaries, or by titling your assets in the name of a revocable trust. Liz, you got any thoughts or feedback in how people decide whether to use a transfer on death or a revocable trust?
Definitely, Walker. I think as you and I meet with clients, a lot of times, you know, we're not forcing people to have a trust created unless it's really necessary. A transfer on death or a payable on death for your bank accounts is very easy to add. It's typically just a free feature. You fill out a form and you can dictate what happens upon your death on those accounts. I will say though, you know, a trust really does come into play when you're having a more complex family situation. I think we see it a lot with blended families, that this can really come into play. You know, I have a client whose husband passed away, and, you know, they're on their second, or were on their second marriage, and he has 2 sons and she has her own. And, you know, she inherited his IRA and she elects her own beneficiaries from there. So I think if you're thinking generations ahead, or you're in a blended family, that really does come into play on some of the planning.
Absolutely. And the TOD instructions or the revocable trust, they speak for you and how you want your assets distributed. It's faster and easier and often cheaper because they avoid probate. One important thing to note with a revocable trust or a TOD is that these instructions supersede a will. So you will need to make sure that these documents correspond and stay current over time. Next slide.
And those account beneficiaries, a lot of times you'll see where a beneficiary may be a deceased individual or who knows what. So those need to be definitely updated periodically for sure.
Every year is a good idea to update that with all these documents.
So this next slide, of all the questions that we ask clients, how much they spend is the most painful question to answer. And it's amazing to think that most people, even those who are very successful financially, they can't immediately answer this question. And it's because it hurts. Coming to terms with what you spend is critical to a successful retirement plan. And you want to arrange your finances in a way that makes it easy not just to calculate what you spend once, but to track it over time. And what this chart shows is that if measured in today's dollars, household spending peaks at age 45 for most categories. Liz, you find this to be true with our clients?
I definitely don't think so. I know people living longer and, their kids getting married later and having grandchildren later. It seems like, the spending does not go down, I'd have to say.
Yeah, I think as a general rule, we prefer to prepare clients to spend just as much in retirement as they do while they're working. Your expenses will change when you retire, but it's dangerous, we think, to assume that your spending will go down. First of all, no one wants to take a cut in their standard of living. And, we could look at a category such as education on this chart and cite an overwhelming number of retirees who are contributing substantially to their grandchildren's education. So our advice is to figure out what you spend per month on average over the course of a year and plan to spend that amount each month once you retire. And next slide, please. So for pharmacy owners, like most retirees, Social Security benefits will replace a significant amount of your income once you're retired. It's important to plan for when to start receiving benefits, and there is no one-size-fits-all solution. So we find that some of the questions asked on this decision tree are helpful in making sure you get as many dollars as you can from the system, given that we can't know how long we're going to live. And I'm not here to dispel any doomsday scenarios about Social Security. What I can attest to is that among couples, at least one of you will live to age 90 about half the time. So taking benefits at age 62 instead of waiting to full retirement age, which right now is between 66 and 67, it reduces your benefit by 6% per year. And you lock that smaller amount in for as long as you live. So if you wait past full retirement age, so past age 66 or 67, your benefit grows by 8% a year until you reach age 70. And then at age 70, you receive that larger amount for as long as you live. If you're married, the surviving spouse gets to keep the larger of your two benefits. So if you have the savings and you can afford to wait, and you or your spouse live into your early 80s, you'll often collect a bigger benefit from Social Security if you wait to take your benefit. So we ask clients to create a My Social Security account. You can do this through the SSA.gov website. And then we have them pass along the benefit amounts for yourself and your spouse if you're married. And we perform a break-even analysis that accounts for Social Security benefits together with all the other sources of income that you have earmarked for retirement. And that really helps us give you the best probability of getting as much as you can out of the program.
And that online Social Security account's also important to make sure that they are tracking your benefits correctly. In other words, a W-2 may have not gotten in there showing those wages, those Social Security wages, or if you're a partnership or self-employed, you need to make sure that's getting in that system because sometimes there can be some errors in there. So that'll help you make sure that the Social Security system is collecting your data correctly so that these benefits can accrue on your behalf.
Very true.
Liz and Walker, we have a lot of pharmacists that will work up into their 70s and 80s. In fact, I'm working on several transactions right now where the owners selling are in their 80s, believe it or not, and working every day. most pharmacists want to start taking Medicare at age 65. And there's always confusion around that age 65 and Medicare, because if you're not taking your full Social Security until, say, 67, then you have to come out of pocket with that for a period of several years. I know that's what I had to do when I started taking Medicare at age 65, and I started taking full coverage at 67. But yet my wife, I'm getting her to wait to age 70. So there's different scenarios you can look at, but you've got to consider all these things with your planners, with your tax advisors, because all this stuff ties together in one giant maze.
Mhm.
Well
Very-
said. All right, next slide, please, Scotty. Prioritize your savings. This is an area where coordination of tax planning and investment planning is so powerful for a pharmacy owner. It is critical to prioritize how and where you save as a means of making sure that your nest egg is both flexible and tax efficient. So communication between your CPA, particularly a CPA that understands the cash flows and the expenses of your business, and your investment advisor really pays off. Some of the issues we see with new clients include poor cash management, that is holding too much cash or not enough, not utilizing the appropriate retirement plan for tax advantage savings, and not accounting for debt when measuring the risk versus the reward of their investments. If you're letting the bank roll your CDs and you are, entrenched in running your business day to day and just too busy to find a better option, the purchasing power of that savings is going to erode over time. If your pharmacy's retirement plan doesn't allow you to contribute the level of tax advantage savings that the cash flow from your business would otherwise allow, it will likely take you longer to accumulate the nest egg that you need for retirement than it could. Of course, every dollar of interest that you don't pay the bank is a guaranteed risk-free return. So making sure you have a plan for paying off your debt and even your mortgage by the time you retire is a good idea, we think. Mortgage at 3 or 4% interest is, it's very attractive by historic standards, but you're not earning that kind of rate of return in the bond market right now, not without taking on a bunch of risk. You had any further thoughts to that, Liz?
I was just gonna kind of echo what you were saying, Walker. It's so true in this interest rate environment. Even holding a lot of debt at 3 or 4% can really erode your overall return, especially if you're risk averse. If you have a lot in bonds or you're, nearing the end or, of your job and going into retirement, it's really when you have to start thinking about making sure that you're allocated properly.
All right, next slide, please, Scott.
Yep.
Okay, what we're showing here is a general rule of thumb in deciding whether to make Roth or traditional contributions to your retirement accounts. And as you may know, the traditional way is to make the contributions pre-tax and take a tax deduction for the amount you contribute in a given year. Being able to contribute the dollars that otherwise would have been paid in tax helps your contributions compound faster. Then the general rule is to defer paying those taxes as long as you can afford to, or as long as the law will allow. None of the contributions or the appreciation when you contribute the traditional way have been taxed. So when you reach age 72, you'll be required to take a portion of your savings out each year, and that amount will be taxed as ordinary income. So that's the traditional way. Roth is basically the opposite advantage. You pay tax on the contributions that you make up front, You don't get to take a tax deduction, but when you retire, all the contributions and the appreciation can be withdrawn tax-free. And since you've already paid the tax up front, there is no required amount that you have to draw each year. Both of these tax treatments are good. Either one is better than investing in a regular after-tax account. But as a general rule, the more time you have, the more the Roth is a benefit. Later in your career or as your income rises, the more benefit you'll have from taking the deduction up front. And that's basically what this chart is showing. And you can see on there too, notice the chart and the required minimum distributions in retirement, the RMDs. They are shown to be smaller than the taxable income during a person's working years. And we've seen cases of individuals who were really good at saving in pre-tax retirement accounts where the RMDs, as they grow older, are as big or bigger than their income was when they were working. It further speaks to the benefit of planning and diversifying the tax treatment of the retirement savings that you have strategically throughout your career.
Walker, we've seen a lot of situations where, let's say, an S corp or a pass-through entity where there's substantial basis has large losses in one particular year or so, and we've actually been able to plan to roll over taxable IRAs into their overall taxable income in those years where there are large losses, again, where they have basis to take those losses to counteract that taxable income and that tax being paid. There's a lot of coordination and a lot of planning there that one can put together to make sure you're maximizing your Roth IRA situations. I know in my instant case, when they started the Roth situation a number of years ago, I rolled over pretty much every bit of the money that I could at that time, paid tax over 4 years. It was a 4-year spread at that time. And boy, am I certainly glad that I did that. On the other hand, I've got substantial accounts that have taxable funds in them. But this requires constant review. Pharmacists in the 30s, 40s, 50s, a lot of times have detailed questions about, well, what should I do? Should I be doing a 401k safe harbor? Should I be doing a Roth 401k safe harbor? Should I be looking at other retirement plan options, including discretionary profit sharing plans, as well as cash balance actuarial plans, where you can put humongous amounts of money in here? We do a substantial amount of work with high income pharmacists that have, let's say, that are in their 40s and 50s and 60s that haven't saved as much as maybe they should have over the decades, and they have plenty of cash flow and typically little debt now. And we really try to maximize all these retirement plans at this stage in their life. But it's a critical time to do planning, and you cannot just ignore this. This is a huge issue. And with the potential Biden proposal, who knows what that's going to be or when that's coming out. My guess is December 23rd at 5 p.m. in the afternoon before Christmas. We don't know when that's going to go into effect. We don't know what changes ultimately they're going to have. There's a lot of discussion going back and forth as always in politics, but you just have to watch these things very carefully because you may need to be making some very serious changes in a short period of time here at the end of 2022, depending on what happens. And it could involve both your Roth and traditional accounts.
Yeah, I'll just add to that. A lot of pharmacies we hear, their plan is to sell their pharmacy, and that's their retirement plan. We disagree with that. Obviously, that's a huge plus in a retirement situation. But these types of planning, the 401k, the safe harbor, the profit sharing, maybe even a pension plan situation, combined with maybe some IRA planning involved, is very important for pharmacy owners to build that wealth and build that full package. So when they do decide to retire, they have a nice nest egg built up. And some of these plans, if you are older, some of these plans will allow you to fund large amounts up front to sort of play catch up, if you will. Obviously, a lot of planning goes into that, but this is a huge planning area, and pharmacies should certainly be paying attention to this retirement plan area with their tax planning and with their planning in general each and every year.
And is actually one question that's come in that kind of ties into this from Devin. He's saying, if you're in for the long haul with your business, is it better for your family to inherit the business, or is it better to sell it to the beneficiaries in a low-cost way so as not to create a big financial burden in the continuance of the business? Under current law, repeating, under current law, at death, the fair market value of the common stock, if there's say an S corp with common stock, gets revalued, or what we refer to as mark to market, to fair market value at date of death. And so again, depending on what happens here in this Biden tax situation, that could dramatically change to the good. It could dramatically change to the bad. So you need to be really keeping your eyes and ears in conversation with your advisors to review your situation, your personal situation. If you're selling this to your beneficiaries, there's some tax issues that you run into as a result of closely held entities. There's certain things you cannot do by selling it to a family member versus selling it to a third party. Sometimes that clouds the situation, but these are very complicated issues that need substantial planning with these.
Okay, next slide, please.
Great. I was going to say this conversation really kind of leads into this next slide here.
This is a good chart here. Yep.
I was going to say there's a lot on this slide, but obviously through our conversations and everything talking up to this point, I think we all are agreeing that taxes really do matter, both now while you're working and saving, and then in retirement as well. So there's a lot of planning that happens around there, and it's a really big driver of maybe what is the best and most efficient plan that you should be engaging in. Really, it makes a lot of sense to take advantage of opportunities to defer, manage, and reduce taxes where possible. This chart, I know we've talked about a lot of different account types and avenues to go, but this is just the three basic that we wanted to kind of bring out and show you the differences between the contribution limits, the contribution treatment, distribution rules, and then the taxes to keep in mind later on. This first column here in the white, the taxable account, or a brokerage account as we call it, anything non-retirement, obviously you're putting in after-tax dollars. You're not going to have any distribution rules on that, but along the way you want to be very mindful of the capital gains that you're paying annually on that. There's also a few other important factors with that account type, and we're going to go into detail on the next slide about that. But then again, just to cover again the traditional 401k and IRA, you've got different contribution limits, and everything that you're putting in there is pre-tax, so you're getting a tax savings today. But you do want to keep in mind, like Walker said, I think we meet with clients who are shocked about how much income they're making in retirement versus while they were working. So at 72, you're going to be required to take out a minimum, and you're going to have to pay income taxes on that. The IRS definitely wants their piece of the pie, so they're going to force you to take out a certain amount. And it's just important to think about this. You don't want to have tunnel vision just on that one sort of account type of storing away pre-tax money, because what if you need to take out even more than your RMD? What if something happens life-wise, once you sell your business where you need to pull out a big portion of money? Your pre-taxable income affects the expense of other things as far as how much Social Security is taxed or what you're paying in Medicare premiums. So I think we're really trying to show here is that you want to diversify your buckets, your account types of when you're saving. The Roth 401k and IRA, again, you have limits on how much you can put in there, but everything is after tax. This is a really powerful tool, especially over the long term, to go ahead and just get all those earnings tax-free, and then that money can come out to you and you don't have to involve Uncle Sam in any regard. Walker and I really do meet with clients, and it again is very specific to your certain circumstances, but we do a lot of break-even analysis and try to come up with the a basis for maybe what your best allocation should be to each of these. If we want to go on to the next slide. Here we just wanted to show that in your taxable account, again, any non-retirement account where you're saving and investing, there are a lot of other things that you can do to be sort of tax efficient along the way. Walker and I utilize these for our clients, and there's certain ones that you're able to utilize on your own too if you are saving outside of a retirement account. I think one of the biggest ones here, one of the most powerful is probably tax loss harvesting. This is when you're actually purchasing securities and then selling them at a loss to capture that loss. You can use that to offset gains in the future and even a portion of your income. Really, I think this came into play, right, Walker, in March of 2020 when COVID hit the scene and the market took a big dip, about 30% across the board. That was a great time to rebalance or swap out of some securities to kind of take advantage of a total market correction. So we did a lot of that for our clients and took advantage in that regard. There's a little bit, there's a couple rules here. I don't want to get too far into the weeds, but obviously you can't capture a loss and buy the same security within 30 days. So you do want to be careful if you're using this strategy. Another one here too that I just wanted to point out, because we see this a lot of times too with frequent trading, is that in a non-retirement account, if you buy and then sell a security in less than a 1-year time period, you're going to be subject to an income tax rate on that gain. You're not going to get the favorable tax rates, the capital gains tax rates that are right now maxed at 20%. Again, we'll have to always follow tax legislation and see where that goes in the future. But it's something we're very mindful of here too. If you're 2 months out from hitting that year, you might want to think about trading or rebalancing right away.
And with capital gains scheduled or being discussed on increasing quite a bit, that tax loss harvesting can be very important to maybe keep you under those brackets that will push that capital gains rate up significantly. There's certainly a planning idea there.
Unless they make it retroactive, which we just don't know what they're going to do or not do.
Yeah.
That's the difficult thing about it.
Well, I think even, to the extent the rate of capital gains goes up, which I think is fair to expect, it just makes tax efficiency all the more critical. So this is where we live. If you think of things in terms of percentages, to the extent you don't measure your return after tax, but you should, because if you got a huge tax bill, it can really eat out of your long-term returns.
Got a question here that's come in from Butch. It says, if your company has a traditional 401k but no Roth offering, do you still have any options to invest in Roth IRA or other ways to avoid taxes later? Who wants to take that one?
But you can contribute to a Roth IRA if you're under certain income limits, which Alan and Scotty, correct me if I'm wrong, it tends to be somewhere around 190,000 in household income for a joint return, where you start to be phased out in terms of being able to contribute both to your 401k and to a Roth. But if you're under that level of income, then yes, it is possible to contribute both to a 401k and a Roth IRA.
And many company plans can be altered by the third-party administrator to add the Roth offering at certain point in times in the year. So that's something you want to talk to your TPA third-party administrator about if you don't have a Roth offering. I know anytime we set up a 401k safe harbor with a discretionary plan, we always put a Roth offering in there because the employees generally want to consider that for sure.
Yeah, it benefits everyone in there to at least have that option.
Yes.
So it's worth taking a look at that.
I think we're seeing it more and more. You probably agree, Walker, but it is still somewhat new in concept sometimes. So So again, just another big part of financial planning is managing your income when you're in retirement. This kind of goes back to what Alan was saying too. You want to take advantage of years where your income is high or low to make sure that you're pulling from the right bucket of money. So it's great if you've diversified, but you want to be able to plan and realize what situation you're in annually to see where it makes the most sense of accessing money. I think, a lot of times, traditionally, people diversify into these buckets and then they think, okay, you know what, let's take all the taxable money first. Once I retire, let's keep deferring taxes as long as possible and then just have the Roth grow beyond that. And depending what your situation is, there could be times where, you actually want to pull out traditional IRA money that's taxable if you have a substantial loss on the other side, or you maybe have a huge, medical deductions, or, it really does depend annually what's going on with your situation and your taxes. I think another good example of this is in 2020, the government actually allowed everyone to skip their RMDs.
Mm-hmm.
And, a lot of people took advantage of that, which is great. And then we actually did have some clients, Walker and I, where it just made sense to keep pushing, pulling money out of it because of where it was going to put the client tax bracket wise in the year ahead to delay it.
And they increased the RMD situation to age 72 from 70. I think that was done in 22, was it not?
You're right. Yep, exactly. Yeah. Cure Act, they pushed that back. Mm-hmm.
Yeah. I also want to remind everybody, if you have incremental questions here that you'd like for us to respond to, don't hesitate to put them in on the question box, and we'll do our best to get to them as we go through the remaining slides.
Great. Thanks, Alan. So that kind of leads into some other ideas that Walker and I wanted to share. A big part of what we do for clients is looking for ways to reduce their taxable income in retirement. So if you're already charitably inclined and you plan on making donations later on to 501Cs, there are 3 quick tips we wanted to share and strategies we utilize that help, maximize the tax benefit to you as the charitable giver. The first one is gifting appreciated stock versus just stroking a check to your favorite charity. If you give cash directly to a charity, you may be able to get that tax deduction. But at the same time, if you're able to gift stocks in kind that have appreciated in value, you're getting the tax deduction and then also avoiding the capital gains tax altogether. On the next slide, if we want to jump to it, we just put some numbers to this to kind of show an example of how powerful this can be. On this example, let's just assume you have $20,000 and you've bought your favorite stock, Apple or Microsoft or whatever it might be, and now it's grown to about 50,000. And let's say, and you're feeling very generous and you want to gift away $50,000 to your charity one year. This shows on the right that if you were in order to sell, if you sold that stock and actually gave the 50,000 in cash to the charity, you'd be paying capital gains on about $30,000 of growth. This assumes that the highest tax rate and then also a Medicare surtax, hitting in. But when you think about that, I mean, you're really taking away from your deductible amount, and then your total income tax savings drops substantially. In this example, down to $15,850. On the other hand, if you had donated in stock, you're completely bypassing the capital gains tax on that growth. The charity is still getting $50,000. You're getting that full deduction, and therefore a greater, income tax deduction to you as the end goal. I think this has become so much easier too. Even your small churches now seem to have a brokerage account and, a dedicated person there who can help you do this. Usually it's just typically a form that you have to sign. Wouldn't you agree, Walker? I think, it's become very seamless to do this.
Exactly. I can't tell you how many times Liz and I have had the conversation with clients, and they'll ask, well, we have our pledge to our church. Is that the type of donation that you mean, where we could use stock instead of cash? And it absolutely is. And you've got positions in your portfolio that maybe have appreciated a lot, have gotten to be big and hard to diversify around without realizing a lot of capital gains. These shares are perfect to use as donations to charitable organizations that you care about, because instead of you realizing the gain, you are able to give that away, and it's not taxable to that organization because that organization is tax-free. So it's just a real win-win situation, and a great place of planning for us.
Just a word of warning, you don't want to wait to the last couple of weeks of the year to try to do this, when a lot of the banks and brokerage firms have reduced personnel because of holidays and vacations, and sometimes it can get tied up and not get transferred correctly. So this is something you want to start early in the fourth quarter if you are planning on doing this.
Definitely, that's
exactly.
And as Walker was saying too, this is such a good rebalancing tool for any of those concentrated positions that you've built up and you can't work around. This is a way to automatically, detract and rebalance along the way, which is great. The second tip is a donor advised fund. We've been utilizing this a lot for clients recently. A donor advised fund is basically a charitable account that you set up at a custodian, let's say a Charles Schwab or a Fidelity, and you actually serve as your own sort of fund officer or trustee of this account in your name. The great thing about this is it gives you more flexibility as a donor. Again, just looking at the slide here, you can donate cash or appreciated stock, so you can still do sort of that double dip on the tax savings. And you basically contribute into this fund, but then have complete control on when and to who you make the donations to. You can actually keep your money invested within the fund and let it continue to grow. And then let's say 3, 5, or 10 years later, distribute it out to the charities. The nice thing here, as you can imagine, is that, when we're dealing with pharmacy owners who are in a huge income year, it might make sense to speed up the future donations you're planning to make. That way you can actually realize it in this tax year. So again, that could be several years out, and you might want to lump some donation in this tax year to offset some additional income coming in.
Yeah, we see this one quite a bit.
Yeah. I think they're becoming a little bit more popular, and again, pretty easy and efficient. We typically go through Charles Schwab or Fidelity form. That's why I brought that up. It's also very cost effective too. And I think the minimum is around 5,000, Walker, maybe, or 10,000 to get that started. So it's not an exorbitant amount that you need to do that. You can also put on their successor trustees and also name beneficiaries in case anything happens to you as well, which is also nice in the succession planning. And then the last one we wanted to bring up here was the qualified charitable distributions. This is when you take a distribution from your IRA and you give it directly to charity, so you're not realizing any taxable income of that distribution to yourself. You do have to do this directly from your IRA to the charity. You can't take receipt of the funds. But this is a great way, if you're obligated to take an RMD and you're actually not needing the income, it might make sense to go ahead and use part of that to give directly to charity, and that way lowering your overall income. I think we are seeing this a lot with clients as well, aren't we, Walker?
Yeah, once you reach the point where you're required to take distributions from a retirement account, those dollars are being taxed at the highest possible rate. So it really is advantageous to the extent you're going to make charitable gifts, to use what you're required to take from your retirement accounts to make those gifts.
And one just note here is that this needs to go from the IRA directly to the charity, not to the individual and then the charity, because sometimes that gets missed here from time to time.
Right. Yep, definitely. And and now custodians are making it a little easier too. You can actually have a checkbook put on an IRA account, which is actually even easier, just to kind of write the check directly out of your IRA. That way there's no question, that there was any receipt of the funds. I also wanted to point out too, you can start doing this at age 70 and a half. That used to be the old RMD age. Now that was pushed to 72, it's good to know that you could still do this after age 70 and a half. but not a day before. So unlike some of these other regulations, I think that's down to the day. I've had that come up before for a client. It's not the year you turn 70 and a half, it's the actual day. We want to go ahead and jump to the next slide here. Walker and I also just wanted to share a few high-level best practices that we find that we're using for portfolio management. So again, this spans across retirement accounts, your taxable accounts. We just wanted to kind of recalibrate and say that, you know, a big focus should be on your asset allocation. By asset allocation, we mean your allocation to cash, stocks, and bonds. Really, that allocation is going to drive most of your investment performance. You could own the best stocks in the world, but if you have half of your assets sitting in cash or at the bank, you're probably not going to reach your long-term goals. Also, diversification is extremely important. I think we've seen it takes maybe one false move to go ahead and do some serious damage within a portfolio. And that could be anything. That could be becoming too concentrated in any one stock, or maybe a sector, or a country. You know, just really trying to harp that if we diversify assets, you know, you're going to take a lot of risk off the table that you probably don't even really need to be taking at that same point. And then again, just risk and cash needs. The cash management piece really comes into play. You never want to have to sell when a market is down. So as we're kind of, you know, reminding everyone to put cash to work and not have a cash drag, you also want to make sure that you have liquidity, so you're not forced to sell at a down market or forced to pull out at the most inopportune time. It'll be harder for your portfolio to recover in that regard. And also just being aware of total costs. You know, as interest rates are low and we're expecting slowing growth in the years ahead possibly, every little bit counts. Me and Walker are very cost conscious for our clients. And a lot of times we're meeting with people who are still investing in mutual funds. And, you know, not to say that mutual funds are bad, but a lot of people are shocked that sometimes even when you pay a trade commission or a sales commission to buy in, that you're still paying an operating cost within that fund. There's an expense ratio that's, you know, embedded in there for the fund manager to run that fund. So sometimes you're paying a lot more annually than you actually realize. And then lastly, we just wanted to also say, you know, we've talked about a lot of different strategies here, and but you never want to undermine your long-term goals. So just to take everything we have said in context, and you know, you don't want to do everything just to avoid taxes, you know, completely, or you don't want to buy stock to have them go down in value just to tax loss harvest. Obviously, you still want to keep an eye on the focus of the long term and your overall goals.
Economics first, taxes come second, always.
Very well
If
said.
you put the tax situation before the economics, you're gonna make an error. Seen it too many times.
Very true. And then lastly, we just wanted to go over, again, just some key takeaways and next steps. I didn't want to call this a to-do list because that sounds like work. But really, if we were supposed to wrap up everything into sort of an action plan, this is what we walk through with every client, and what we would recommend everyone do after watching this. Again, just to make sure your estate documents are in order, the will, DPOA, advanced medical directives. Make sure your assets are titled accordingly to avoid probate, and also verify that your beneficiaries are up to date and accurate. Prioritize your savings and utilize those different account types, taxable, Roth, and also the 401k or another cash balance plan that you're using. Identify current and future expenses so you can create a savings plan, and also from there turn it into a withdrawal strategy in retirement. Make sure to manage and monitor your investments to be tax efficient along the way where you can. And then finally, just make sure your investments are designed to meet your long-term goals.
Yeah, what we're trying to outline here are those things that matter most. Where can we have the biggest impact? And it's often with things that they're not talking about on TV right now. It's with high-level things, personal things that speak specifically to you and your goals and the people you care about. And that's where we can make the biggest impact.
Any lasting comments, Liz and Walker, you'd like to push out, here's your contact information directly here on the screen with your direct phone numbers and your email address. Anything else that you guys want to add?
Thank you. It's been great. We've covered a lot of ground. And if you think you might benefit from a review of your current plan for retirement, a friend of Sykes Company is a friend of ours. So we would be delighted to speak with you and answer any questions that you have.
Well, thank you very much for both of you being on this call today. Just to be clear, we have no conflicts of interest with Palladium or any other vendors that we deal with. We talk very openly about all vendors we deal with, unlike others in the industry. Scotty, you want to just touch real quickly on the ARCS assessment? Because I know we have a lot of pharmacists on this call.
Yeah, and then we got a couple questions, it looked like.
Yep.
Sykes Company, we do an RX assessment service. So if you are kind of unsure about your accounting or tax situation there at your pharmacy and want a third-party opinion about where you stand, about issues, concerns, opportunities, we can certainly provide that service for you. You'll walk away certainly with a roadmap, if you will, of what the things you need to work on. And what we see in your pharmacy and the opportunities you have, and really give you that peace of mind of exactly what you need to do going forward. We do charge $1,495 for that service, and if you go to our website, sykes-cpa.com, at the very top of the homepage, you'll see ARCS Assessment Service. You'll just click on that, go through the information, submit your accounting file, your tax returns, and then we'll get you on a video call soon thereafter and go over your situation. So happy to do that for anyone out there just looking for that third-party overview. Again,
there will be substantial actionable items most likely that come from that analysis, in case anybody is wondering. And Mr. Peter, your question here is quite extensive. If you don't mind reaching out to us through Ask Sykes, it's sykes-cpa.com. We'll attempt to reach out to you sooner rather than later and discuss it. The slides, we've had several people ask about the slides. Assuming you registered for the program, whether you showed up or not, our intention is to push out the web link, which will include the slides and the video recording within the next 48 hours. So just be on watch for your in your email account, please. And Liz, Walker, Scotty, it's been a pleasure to be here with everybody today, and we've covered a lot of stuff. And going into year end with changes in tax laws and stuff, Lord have mercy, there's a lot to be dealt with. So it's time to get busy, isn't it?
Definitely.
It is.
Well, thank y'all very much for being on the call with us today.
Thank you, guys, and we'll do it again soon sometime.
All my best to my buddy Dick.
I will send your best. He sends it back. Thank you.
All right. Take care.
Take care.
Bye-bye.
Thank you.
Thanks, guys. Take it easy.